Hi guys, good evening. So as usual, we are going to start the fourth day of this practice to pass webinar session. So on the first day, we discussed about inheritance tax. The second day, we went through some aspects of capital gains tax. And yesterday, the third day, we discussed some of the aspects that can be tested under employment income. So today we are going to discuss another important area for your exam, that is the tax implications with regard to unincorporated businesses. The tax implications with regard to unincorporated businesses. Now let me share the presentation slides that I have uploaded. So if you go to the handout section, from there you will be able to download several materials that we have shared with you guys for your reference. Now, here, if I may give you an introduction to the area that I'm going to discuss today. Now, most of the things that we learn under this topic, you have discussed for F6 as well. Okay. However, the same knowledge will be important for your exam purposes also. But the same will be important for your advanced taxation purposes as well. Now, under this topic, we are going to look at how they can test your knowledge pertaining to unincorporated businesses or business income at the exam. Now, if you look at your past papers, you will see they can always use an unincorporated business scenario to check your knowledge pertaining to several other tax implications that we have already discussed. A typical question can be like this, especially if it is a section A type of question where they have allocated 35 marks or 25 marks. That is, they can say you have commenced your business as a sole trader or partner of a partnership. And now you have made a decision to convert your business into a company. Now, if they use a scenario like that, the examiner is in a position to test everything that you have learned under P6 syllabus. If they can use a scenario like that, where currently you are running a business as a sole trader or partner of a partnership, but now you intend to convert your business into a company. So they are in a position to test your knowledge pertaining to almost everything that you have learned under advanced taxation syllabus. How? With regard to the unincorporated business, you generate a trading income that can be used to check your knowledge pertaining to individual income tax computation. Then if you have made a decision to transfer your business into a company, then the assets are transferred to a newly formed company. They can check your knowledge pertaining to capital gains tax implications as well. In particular, the availability of incorporation relief or entrepreneur's relief. So you will be asked to make a comparison and see which relief is more viable in a situation like that, whether to proceed with the incorporation relief or entrepreneur's relief for the purpose of CGT. When you transfer assets, if you have land and buildings, then they can test your knowledge pertaining to stamp duty, land taxes as well. And then if you have decided to give this business, without receiving any consideration, in that they can check your knowledge pertaining to inheritance tax as well. On the other hand, now you have converted the business into a company. So when you're running as a company, then you need to identify the corporation tax implications. And when you're transferring assets, you have to consider one more aspect, that is value-added taxes. So at the exam, they can use a scenario like that to test your knowledge pertaining to so many tax implications that you have learned under advanced taxation. So you can see this knowing unincorporated business tax implications will be extremely important for the exam. Okay. So now let me explain the main principles that we need to know under business income or trading income. Okay. Right. Here, it is important to figure out whether we are into trade or whether it is a chargeable gain. Now, if you sell a land or if you sell a motor car, most of the time it will be treated as capital gain. But if it is a motor car, we know it's an exempt asset for the purpose of CGT. But if you sell land, or if you dispose shares, they will be treated as transactions for the purpose of CGT. But if you are in the business of selling lands, if you are in the business of investing in shares and selling those investments, especially if you are in the business of selling properties, that may not be considered as a capital transaction. It may be considered as a property investment business. Then you will not be subject to CGT. The profits that you generate from those transactions may be treated as trading income. So, as taxpayers, as I have already mentioned, it is always beneficial for the taxpayer to consider a particular income, a particular profit as under CGT, rather than consider it under income tax, because the income tax rates are higher than the CGT rates that are applicable. However, when it comes to certain transactions, it's little difficult to figure out whether it should be treated as trade or whether it should be treated as a capital transaction that is subject to CGT. So to clarify that doubt, we are using something called badges of trade. We use something called badges of trade. Now, these are the badges, these are the tests that we are using. Now, remember, one test is not conclusive. You need to use all these factors, all these tests collectively, and then you need to come to a conclusion whether it should be treated as trading income or chargeable gain for the purpose of CGT. So one test cannot be considered as, any one test that you have been given here is not conclusive. So you have to look at the totality, and based on that, you have to arrive at a logical conclusion. So these are the tests that we are using. You look at the subject matter. So the asset that you have sold, the property that you have sold, the item that you have sold, is it something that you can use for personal use, or something as investment purposes, or is something to do with trading? Now, normally when you buy a property, straight away you can come to the conclusion it is for your personal use or for the purpose of investment. Normally, when you're selling land, we will not consider it as trading. However, if you have bought, say, if you have if you are in the, I mean, the transaction, the subject matter pertaining to transaction is selling some sugar. Now, if you look at the subject matter, nature is such, it is not, if you have sold a huge quantity of sugar, in that case, no, maybe not, you cannot consider it for personal use or investment purposes, then probably we will come to the conclusion that it is a trading transaction. It is something to do with a trade, because subject matter is such, normally we deal with trading. Then the ownership period. Normally, if you are in the process of doing a business, if you are doing a business, when you purchase an asset, you don't intend to hold the asset for a long period of time. Then it's not a successful business. For you to run a successful business, you should be able to convert your purchases into sales. So if you have held the asset for a very long period of time, it indicates non-trading. But if you have been able to bought the asset and sold the asset within a short period of time, it indicates trading. Then frequency of transactions, I hope you understand that. If the number of transactions, the volume of transactions are high, if it is more than one transaction, if it is several transactions, that indicates trading. And if you have done improvements to the asset before you sell the asset, that again indicates trading. And reason for sale. If you have sold the asset because you have some financial difficulty, you need cash for an urgent matter, in that case, that indicates non-trading. But if you have sold it with the intention of generating some profits, it's not due to any emergency, it does not indicate trading. It indicates trading. It indicates trading. Then the motive, if you have sold the item with the intention of earning profits, then basically it's considered as trading. In addition to this test, sometimes we are using 3 additional tests as well. One is finance, how the asset was financed. Now, if you have obtained a loan to buy the property, in that case, normally it indicates trading. As I said, normally, it's not conclusive, but most of the time we can come to the conclusion it indicates trading. Because if you have obtained a loan to buy the asset, we can assume that you intend to settle the loan after selling the asset. So that's how most of the time businesses function. Take a loan, from that money you buy the property, and then you sell the property. From the sales proceeds, you settle the loan, and the balance you keep. So that is your profit. Then the acquisition method. How have you acquired the asset? If you have received the asset as a gift, or if you have inherited the asset on the death of a person, now you have sold it, it does not indicate trading. Then earlier also we had a similar one, similar test called frequency. Here also similar transactions. Similar transactions. So if you are in there are similar here, similarities to an existing trade indicate trading. So if you're already in a business, if you have made several transactions which are similar in nature, in that case it indicates trading. It indicates trading. Then the next thing is, if you have identified it as trading, then you are required to calculate the profits that you have generated from trading. Then you need to calculate the profits that you have generated from trading. The important thing that you need to understand here is that the accounting profit is different from the profit that we use for the purpose of taxation. Accounting profit is not a concept that is recognized in taxation, because those two are completely different areas, completely different subjects. Therefore, we cannot rely on the accounting profit that you have calculated by preparing the income statement. Hence, you need to make certain adjustments to convert your accounting profit into tax-adjusted trading profit. So there are certain adjustments that you need to make to your accounting profit. So this is net profit as per statement of profit or loss. So that is what we call the accounting profit. So we cannot rely on that accounting profit. We cannot rely on the accounting profit. Therefore, this profit must be converted into tax-adjusted trading profit. So in doing that, you will see to calculate the profit, we need two items. One is income, the other one is expenditure. One is income, the other one is expenditure. So if you look at expenditure, if you take expenditure, the expenditure that we use in accounting may be different from the expenditure recognized in taxation. Accordingly, if we have used a different treatment in taxation, you are required to make certain adjustments to the accounting profit that you have used here. Net profit as per accounts. So you can't rely on this profit because we need to calculate the tax-adjusted trading profit. To calculate the profit, we use both income and expenditure. When it comes to expenditure, most of the expenditure allowed in accounting are also allowed in taxation. Most of the expenditure allowed in accounting are allowed in taxation as well. So if it is an expenditure allowed in both accounting and taxation, you don't require any adjustment. You don't need to make any adjustment. But there are certain expenditure they are allowed in accounting but not allowed in taxation. The best example that I can give you is depreciation. It's a concept. It's an expenditure recognized in accounting, but not acceptable in taxation. Not acceptable in taxation. Not acceptable in taxation. In that case, you need to adjust it. How can you adjust it? This was deductible when calculating the accounting profit, but not deductible under taxation. Therefore, you have to reverse the deduction that you have made previously. To reverse something that you have deducted previously, you have to do the opposite. That is, you need to add it back. Likewise, there are certain expenditure not allowed in accounting, not acceptable in accounting, but only allowed in taxation. There, the example that I can give you is capital allowances. It's not a concept recognized in accounting, but only acceptable in taxation. So here, capital allowances you have not deducted when you were calculating the accounting profit, but in taxation it's permitted, therefore you can deduct it. So this is how you can adjust expenditure when you're converting your accounting profit into tax-adjusted trading profit. Likewise, you can do a similar thing when you're adjusting income. Some income are chargeable and taxable in both accounting and taxation, then no adjustment required. Some income recognized in accounting but not taxable in taxation, then you need to deduct that kind of income. For an example, if you take rent income, interest income, dividend income, profit on disposal of assets, now they are considered, they are added when calculating the accounting profit. But when you're calculating the tax-adjusted trading profit, definitely profit on disposal of an asset is not a taxable profit, because profit on disposal is calculated using accounting principles. Therefore, profit on disposal of an asset is not a taxable profit. On the other hand, if you look at rent income, interest income, dividend income, now those income, they are taxable, but they cannot be taxed under the heading trading profit. Rent income will be taxed under the heading property income. Interest income will be taxed under the heading savings income. Dividend will be treated under dividend income. Those income we cannot include under tax adjusted trading profit, though we have included them when calculating the accounting profit. So you need to reverse those items by deducting them. You need to reverse those items by deducting them. Then on the other hand, there are certain income not included under accounting but still taxable. In that case, you need to add them when calculating the tax adjusted trading profit. When you calculate the tax adjusted trading profit. Okay, right. So that is how you calculate the tax adjusted trading profit. Then, so you can see, when it comes to unincorporated businesses such as sole traders and partnerships, we are only permitted to deduct expenditure that we have incurred wholly and exclusively for the purpose of trading. When you're calculating the tax adjusted trading profit for an unincorporated business, we are only allowed to deduct expenditure incurred wholly and exclusively for the purpose of trading. No private items are allowed as an allowable expenditure. So if there's any element of private use, we need to disallow it. For an example, if you are sharing your, if you use part of the premises for both private and for business purposes, then the expenditure attributable to your private use must be disallowed. You cannot claim them as allowable expenditure when calculating tax adjusted trading profit. And no salary for proprietor, but if he's using family members, they are allowable expenditure, but it has to be a reasonable amount. If you have paid excessive salaries to family members, then the excess salary paid will be disallowed. And then we know depreciation is not an allowable deduction when calculating the tax adjusted trading profit. Then if there's a loss on sale of asset, disposal of an asset, not an allowable expenditure. No improvements because it's a capital type of expenditure which you cannot deduct. If it is a repair, you need to consider whether it's an improvement, whether it's a capital expenditure or not. Now, especially when it comes to initial repairs, they may be considered as capital expenditure. In that case, you will not be able to claim it as an allowable expenditure when calculating the tax adjusted trading profit. For an example, now, if you look at initial repairs, how do you identify whether it's allowable or not? If you can use the asset without the initial repairs, then it is an allowable expenditure. But if the initial repairs are essential to convert the asset into usable condition, in other words, if you are not in a position to use the asset without the initial repairs, if it is extremely essential, then it is not an allowable expenditure. It should be treated as capital expenditure. Okay, then some of the other disallowable expenditure. If you have leased a car where you are paying the lease rental, and if the carbon dioxide emission of the car exceeds 110 grams per kilometer, you have acquired a car by paying a lease rental, and if it exceeds 110 grams per kilometer, the carbon dioxide emission, that means a high emission car, then the total lease rental paid is not an allowable expenditure. The total lease rental paid is not an allowable expenditure. Only 15% of the leasing cost, only 85% of the leasing cost is allowed. Balance 15% is disallowed. But if the carbon dioxide emission of the car is 110 grams per kilometer or less, you don't need any adjustment. You can claim the full amount. If it is a high emission car, 15% you need to add back because it's disallowed. Then legal cost. Now, if you have incurred legal cost to acquire a property, now that is a capital type of expenditure, then it's not allowed. However, there are special types of legal costs that are allowable when calculating the tax-adjusted trading profit, such as if you're renewing a short-term lease. What a short-term lease? What is it? It's a situation where the lifespan of the lease is limited to 50 years or less. But remember, you're only permitted to claim cost of renewing the short lease. If the question says you're granting a short lease for the first time, granting of a short lease for the first time is not an allowable expenditure, but if you are going to renew an existing short-term lease, then that cost is an allowable expenditure. And if there is a dispute on a property owned by the business, so if there's a legal action against a property that you own, so to settle that dispute, you need to file an action. You need to sue the other party. You have to go for litigation. In that case, the cost pertaining to that is cost of defending the title, the ownership of an asset, is an allowable expenditure. Then the cost of raising loan finance, not capital, but raising loan finance, that is to obtain a bank loan, that kind of a loan facility, if you are incurring certain costs, they are also allowable expenditure. Then other items include, these are disallowable expenditure, fines and penalties. Now, if the business is paying fines and penalties of an employee, such as parking fines, they are allowable. But if you are paying fines and penalties of the owner of the business, then they are not allowable expenditure. When it comes to donations, remember, only local donations are allowed. National charity donations are disallowed. Local charity donations are allowed, but national charity donations are disallowed. Then when it comes to gifts, if you make a gift to an employee, it's an allowable expenditure when calculating the tax-adjusted trading profit. But if you make a gift to a customer, normally it's not allowed. However, if you can satisfy 3 conditions, if all 3 conditions are met, then that gift to a customer is an allowable expenditure. What are the 3 conditions that you have to meet? The value of the gift per person per annum should be £50 or less. And the other thing is, it shouldn't be food, tobacco, beverages, or vouchers, cash vouchers convertible into goods, cash vouchers convertible into goods. So if it is food, tobacco, beverages, or vouchers convertible into goods, then it's not an allowable expenditure. The third condition, it should have some kind of a conspicuous advertisement, that some kind of a promotional value. If all 3 conditions are met, then it is an allowable expenditure. Then on the other hand, entertainment cost. When it comes to entertainment cost, remember, when it comes to entertainment cost, when it comes to entertainment cost, there, entertaining staff is an allowable expenditure. But when it comes to entertaining customers, not an allowable expenditure. Then impaired debts, that means bad debts. If you have written off a bad debt with regard to trade, then it's an allowable expenditure. But if you have written off a non-trade debt, then it's not an allowable expenditure. Then interest payables, if you have obtained a loan for the purpose of trading, that interest is allowable. But if you have obtained the loan for non-trading purposes to buy some kind of an investment asset, then it is not an allowable expenditure. Okay, right. Then other adjustments required: taxable trading income not included in the statement of profit or loss. Now, if you have obtained goods for own use, if you have obtained goods for own use, we call it goods drawings in accounting. We call it goods drawings in accounting. Now, if you have not made any adjustment in accounting to record the goods taken by the owner for his own use, that means the owner has taken goods from the business for his own use, but in accounts you have not recorded anything at all. However, for the purpose of taxation, it should be treated as normal sales. Even though the owner has taken goods for his personal use, for the purpose of taxation, it should be treated as normal sales at the market value. Normal sales at the market value. That means assume the market value of the goods taken by the owner is £1,000. Is £1,000, but the cost of those goods is £800. £800. In this situation, for the purpose of taxation, you need to treat it as normal sales. Therefore, when calculating the tax-adjusted trading profit, your sales revenue should increase by £1,000 if you have not recorded this transaction at all in accounting. So no adjustment made in the accounts, so add back the selling price, so add 1,000. But there can be situations where you have recorded this transaction in accounting as goods drawings. Now, when you account for goods drawings, what's the double entry that you use? What's the double entry that we use when you're recording goods drawings? Purchases account, drawings account debit, purchases account credit. Drawings account debit, purchases account credit. That means the purchases value should come down. Your expenditure value should come down. That means your profit should increase. But what matters here is, in accounting, when you record goods drawings, we use the cost value. In accounting, we use the cost value to record a transaction. But for the purpose of taxation, it is not the cost that we should take into consideration, the market value only. In accounting, you have recorded the cost 800, but for tax purposes, you should take the market value. Since you have already recorded 800, what you should do is take the difference 200 and add your increase your profit by £200. If correct entry is made in the accounts, only add back profit element. The difference between the market value and the cost is the profit, which is £200. So you just add £200 to your tax-adjusted trading profit. If you have not recorded anything at all, then you have to increase the profit by the market value, the selling price of the product. Okay? Then when it comes to non-trading income, I told you, in accounting, when you're calculating the net profit, we do not limit to trading profits. In addition to the gross profit or the trading profit, we take interest income, rental income, dividend income. We take all those income when you are calculating the when you're calculating the accounting profit. But for the purpose of taxation, But for the purpose of taxation, when you are calculating the tax-adjusted trading profit, you have to ignore any non-trading income. It doesn't mean that they are not taxed. They will be taxed, but not under the heading tax-adjusted trading profit. Here, the whole purpose is to calculate the tax-adjusted trading profit. So if you have any income which is nothing to do with trading, you need to exclude them, but you will have to pay taxes on those non-trading income separately, such as property income, dividend income, savings income or interest income, and even capital gains. Now, dividend income, now when you're calculating taxable income, for the purpose of income tax, taxable income, for the purpose of income tax, what do we include? We include employment income. We include trading income, property income, dividend income, and interest income. So, but we do not include dividend income, property income, and savings income under the heading trading profit, because they should be treated as three separate sources of income, not under the heading trading income. After adding all those income, we will be able to calculate the taxable income. Capital profits will be subject to a separate tax under CGT. So that's how it works. Therefore, when you were calculating the accounting profit, if you have included this kind of non-trading income, you need to exclude them from the tax-adjusted trading profit computation. I hope it's clear. Then, other adjustments when calculating the tax-adjusted trading profit. A commonly tested one is there, but not in detail, but with a simple computation. That is what we call capital allowances. This is a concept identified only in taxation. It's not a concept recognized in accounting. Therefore, for the purpose of calculating the tax-adjusted trading profit, we need to calculate the capital allowances separately. In a while, I will explain the principles pertaining to capital allowances. Then, if the proprietor, if the owner of the business has incurred expenditure on his own for the purpose of business, you should be able to claim them as allowable expenditure. If the owner has paid the electricity bill of the business from his own money, not from the money in the business, but from his own pocket, if he has settled the electricity bill or the rent of the business premises, then those are allowable expenditure. Then the portion of the short lease premium paid. Now, for this purpose, we are using a special calculation. Now, we use a special formula to calculate the assessable lease premium. Now, I will quickly explain it since it's there in the syllabus. That is, if you receive a lease premium, then as the landlord, you have to pay taxes on that. How do you calculate the assessable lease premium? We are using two methods to calculate this answer. I am using this method, that is lease premium into 51 minus n divided by 50. This is one way of calculating the assessable lease premium. If you are the landlord, the owner of the property, so you receive a premium, it's an income. Under property income, you have to pay taxes. However, the full lease premium will not be assessed. Instead, you will be taxed on a reduced lease premium, and this is one way of calculating it. The other method of calculating is you take the lease premium, from that answer, you deduct lease premium into into n minus 1 into 2%. So calculate that, get the answer, and deduct it from the lease premium received. Then also you get the assessable lease premium. Then also you get the assessable lease premium. Assessable lease premium. Whatever the method you use, you will get the same answer. Here n means the time period of the lease, and this calculation we are only using for short-term leases where the lifespan of the lease is 50 years or less. 50 years or less. Okay, right. Then here you calculate the assessable lease premium and you pay taxes if you're the landlord. But this is the opposite of that. Here we are the people who have paid the lease premium. We are not the landlord. We are not the people who have received the lease premium. We are the people who have paid the lease premium. In that case, it is an expenditure for us. But here you are permitted to deduct it as an allowable expenditure over the lifespan of the lease. For an example, assume the lease premium paid is £30,000. £30,000. And it is for a period of, say, 31 years. The lease time period is 31 years. So 51 minus n, 31 years, divided by 50, you get the assessable lease premium. You get the assessable lease premium. So here 51 minus 31 is 20. Here you get £12,000 or £6,000. Wait. Yeah, £12,000. You get £12,000. So this is the assessable lease premium. So over 31 years time period, you can claim £12,000 as an allowable expenditure. Over a period of 31 years, you can claim a total of 12,000 as an allowable expenditure. That means every year you can claim 12,000 divided by 31 as an allowable expenditure. So at the exam, you will be tested on short-term leases, not on long-term leases, so you don't have to worry about that. So here, what you need to remember, £12,000 is the total expenditure that you can claim. So you divide it by 31, then you get the lease premium relevant for each year that you can claim as an allowable expenditure. Okay, right. Then capital allowances. Now, when it comes to capital allowance computation, you must be familiar with capital allowance computation because this is an area that can be tested at the exam, but you don't have to do a very long capital allowance computation like you used to do in F6, but knowing the principles will be important for the exam. Now, capital allowance computation consists of several principles. So there are different ways that you can claim capital allowances. There is something called annual investment allowance. Now there, during a tax year, if you have purchased plant and machinery, you can claim annual investment allowance up to 1 million. You can claim annual investment allowance up to 1 million. So it's a big amount. So if you have invested in plant and machinery worth of 1 million during a particular tax year, then the full amount 1 million you can claim at once as allowable expenditure or as capital allowances. However, the annual investment allowance is not available on motor cars. On motor cars, you cannot claim annual investment allowance. On the other hand, this annual investment allowance 1 million is available for a period of account of 12 months. If the period of account is 12 months. So if your period of account is less than 12 months or more than 12 months, then you need to time apportion the 1 million limit. So this 1 million is for a period of 12 months. If your accounting period is 12 months, you can claim annual investment allowance up to 1 million. However, if you have prepared accounts for less than 12 months, then you have to divide it by 12 and multiply it by whatever the accounting period. Say your accounting period is 9 months, then what you should do is 1 million, you divide by 12 and multiply it by 9. If your accounting period is more than 12 months, say you have prepared accounts of 15 months, then again you need to time apportion the 1 million by dividing it by 12 and multiply it by 15. So there you can get the total annual investment allowance that you can claim. As I said, you cannot claim AIA on motor cars. Then there's another special way of calculating capital allowances. That is what we call first year allowance. Now that is available on energy saving plant and machinery. If you have invested in new energy saving plant and machinery, you can claim first year allowance. There are 100% of the cost. 100% of the cost you can claim as first year allowance. So if you have spent £10,000, say to buy energy saving plant and machinery, or even it can be a new low emission car. A low emission car is a car where the carbon dioxide emission is 50 grams per kilometer or less. And if it is a new low emission car, not a second hand one, not a used one, if it is a new one, you can claim 100% of the cost as first year allowance. This is applicable to any type of energy saving plant and machinery or environmental friendly plant and machinery. So that is what we call first year allowance. And one more thing, like annual investment allowance, we don't have to time apportion first year allowance. Whatever the cost you incurred, 100% you can claim as first year allowance, notwithstanding the time period of the accounting period of the business. Okay, and then if you take a situation like this, so you have claimed annual investment allowance on energy saving plant and machinery, you can claim first year allowance. What about the other plant and machinery on which you cannot claim AIA or FIA? First, you can consider the plant and machinery which are qualifying for AIA, and then you can consider the plant and machinery which qualifies for FIA, but there are certain plant and machinery not qualifying for AIA or FIA. Then those assets, those plant and machinery must be included in the main pool. They must be included in the main pool. Now, normally, motor cars, which are not new low emission cars or high emission cars, are included in the main pool. So you need to first figure out whether it qualifies for AIA. or whether it qualifies for FIA. If not, normally they are included in the main pool unless it is plant and machinery included in the special rate pool. So how do you identify whether it should be included in the main pool or special rate pool? Any plant and machinery that is not included in the special rate pool must be included in the main pool. Any plant and machinery that is not included in the special rate pool must be included in the main pool. So how do we identify whether it should be included in the special rate pool? It's always better to remember the type of plant and machinery that are normally included in the special rate pool. We include high emission cars. We include high emission motor cars where the carbon dioxide emission is more than 110 grams per kilometer in the special rate pool. In addition to that, long life assets. What are long life assets? They are assets with a lifespan exceeding 25 years and with a cost exceeding £100,000. We call them long life assets. They are included in the special rate pool. In addition to that, centralized AC systems, air purification systems, then water heating system, ventilation systems, then integral features of a building, they are also considered as items included in the special rate pool. Any item that is not included in the special rate pool must be included in the main pool. If plant and machinery are included in the main pool, you can claim written down allowance of 18%. If it is included in the special rate pool, you can claim WDA at 6% only. If it is included in the main pool, you can claim WDA at 18%. But if it is included in the special rate pool, you can claim only 6%. So that's the difference. So most of the time, high emission motor cars where the carbon dioxide emission is more than 110 grams per kilometer are included in the special rate pool where you can claim WDA at 6%. Then we have another concept called short life assets. That is, if you have purchased the asset with the intention of selling it within a period of 8 years, you have bought the asset with the intention of selling it within a period of 8 years, in that case, you treat it as a short life asset without including it in the main pool. You can maintain a separate column only for that asset. And one other important thing when you are doing the capital allowance computation for an unincorporated business, the private use element. If there is any asset where there is a private use by the owner, not by an employee, but by the owner, you cannot include them in the main pool or in the special rate pool. For each asset used by the owner for his private purposes, you must maintain a separate column. So if the asset is used by the owner for his private purposes, then you cannot include them in the main pool or the special rate pool. You need to maintain a separate column for that. Right? So that's how you maintain it. So main pool, special rate pool, short life asset, and private use asset. Because if there is any private use element, your capital allowance claim should be restricted only to the business use. Say the asset is used 80% for business use and 20% for private use. Then when claiming capital allowances, remember, you can claim only up to 80%, balance 20% is disallowed because of the private use element. Okay, so you have annual investment allowance, you have first year allowance. If not, they are included in the main pool, and claim written down allowance of 18%, provided your period of account is 12 months. If not, you need to time a portion. And on the special rate pool items, you can claim a WDA of 6%. If the period of account is 12 months, if it is different from 12 months, then you need to time a portion again. Short life asset, you maintain a separate column, and within a period of 8 years, you will sell the asset. At that point, you can claim either the balancing allowance or balancing charge. On private use assets, you calculate the capital allowance in the normal way, but from that, only 80% you can claim, only the business use element you can claim as capital allowances. Okay, so it's an important computation that you need to go through. Okay, so WD at 18%, WD at 6%. Here, private use asset. You calculate the capital allowance in the normal way, but from that only you can claim business use. And there's another concept called small pool WDA. These things have not been tested, but it's there in the syllabus. A small pool WDA is a situation where the balance of the main pool or the special rate pool becomes too small. If the main pool or special rate pool balance becomes £1,000 or less, if the main pool balance, say the main pool balance becomes £1,000 or less, in that case, you don't have to claim 18% because the pool balance has become too small. So no point of claiming 18%. In that situation, you are permitted to claim the full available balance as written down allowance. We call it small pool WDA. That means the main pool has become small. Then you don't have to calculate only 18%. The full amount available in the main pool you can claim as capital allowances. Okay, right. So I explained what first year allowance is. I explained what annual investment allowance is. And when you are claiming annual investment allowance, it's always advisable for you to claim annual investment allowance on plant and machinery normally included in the special rate pool before plant and machinery included in the main pool. Reason is, now forget about these two, they are not important, but when you're claiming annual investment allowance, if you have both special rate pool plant and machinery and main pool plant and machinery, it is always advisable for you to claim capital annual investment allowance on special rate pool, because if you miss the opportunity on special rate pool plant and machinery, you can claim WDA at 6% only. But main pool, even though you miss the opportunity of claiming annual investment allowance, still you're in a position to claim WDA at 18%. WDA at 18%. Special rate pool items you can claim at 6%. Only 6%. Therefore, when you have the opportunity of claiming annual investment allowance, always go for special rate pool items first. If that is not enough, then you can go to main pool. So that's a sequence that you need to maintain. Okay. Then, so I explained written down allowances, 18%, 6%, and small pool WDA, and restrict for private use by the proprietor. Then when it comes to cars, motor cars, on motor cars, we know we are not permitted to claim AIA. You can never claim AIA on motor cars. Your ability to claim capital allowances on motor cars depends on the carbon dioxide emission of that motor car. Accordingly, we can identify low emission motor cars, high emission motor cars, and moderate emission motor cars. So what is the low emission motor car? Low emission motor car, that is a situation where the carbon dioxide emission is equal or less than 50 grams per kilometer. If it is a low emission car, then you need to check whether it's a new car or second-hand car. If it is a new low emission car, you can claim first year allowance 100%. But if it is a second-hand low emission car, a used low emission car, then you cannot claim first year allowance. It must be included in the main pool on which you can claim WDA at 18% per annum. If the accounting period is more than 12 months or less than 12 months, this 18% you need to time a portion. Then a standard emission car where the carbon dioxide emission is 50. The carbon dioxide emission, if the carbon dioxide emission, I hope you can hear me now. So if the carbon dioxide emission is more than 110 grams per kilometer, 110 grams per kilometer, it's a high emission car, then it should be included in the special rate pool where you can claim WD at the rate of 6%. However, whatever the motor car you use, whatever the carbon dioxide emission, if the owner uses the car for his private purposes, not an employee, but the owner uses the car for his private purposes, in that case, only up to the business percentage you can claim it as capital allowances. The private use element is disallowed. Okay, right. Then short life assets, not a very important one, but since it's there, I just explain it. In that situation, if you have bought the asset with the intention of selling it within a period of 8 years, you maintain a separate column and you claim normal WD on this until you dispose the asset, you calculate normal WDA. So that is at 18%. Short life assets are always assets normally included in the main pool, but since you intend to sell them within a period of 8 years, for a period of 8 years, in that case, you maintain a separate column and you claim normal WDA at 18%. At some point, if you sell the asset, you will have either a balancing allowance or balancing charge. Balancing allowance is a situation where you have sold the asset. Now assume this is a situation like this. So short life asset, there's a tax written down value, of 5,000 pounds. 5,000 pounds. That means you have the opportunity to claim capital allowances up to 5,000. But you are selling the asset for 3,000 pounds. 3,000 pounds. So that means you have been able to recover 3,000 pounds out of this 5,000. The balance 2,000 at once you can claim as capital allowances. You call it balancing allowance. So you have the potential of claiming 5,000, but since you sold it for 3,000, you have been able to recover 3,000. on the balance 2,000, you can claim balancing allowance advance. So it will increase your capital allowances figure. But what if you have a situation where the tax written down value is £5,000, but you have sold the asset, for £6,000, £6,000. In that case, this indicates you have claimed capital allowances more than you're permitted to claim. The maximum you should be able to claim in the future should be restricted to 5,000. However, you have been able to sell the asset for more than 5,000, which indicates, the minus figure indicates you have claimed capital allowances more than you are required to claim. So this is what we call balancing charge, where your capital allowances will reduce. Capital allowances will reduce. Okay, so this is not favorable to the taxpayer if you have a balancing charge. Now, if you do not sell the asset within a period of 8 years, so you are required to sell the asset within a period of 8 years, but if you have not sold the asset within a period of 8 years, then you cannot maintain that asset as a short life asset anymore. Then the asset must be depooled, depooling of an asset. So depooling of an asset is a situation you maintain depooling is a situation where you take it out from the main pool. If you intend to sell the asset within a period of 8 years, you don't record it in the main pool and you maintain a separate column for that. We call it depooling. However, if you do not sell the asset within a period of 8 years, you have to return that asset into the main pool. You call it repooling. So those are concepts that we have with regard to short life assets. Okay. Then I explained about private use assets. So I explained about balancing adjustments. This is not actually important, but you asked this question, what is depooling? Depooling is a situation without recording an asset in the main pool, you record it in a separate column. We call it depooling. You are taking it out from the pool. You call it depooling. Then I explained about the balancing allowance and balancing charge. And this is an important thing to remember. At some point, if you cease trading, that means if you decide to stop doing business, that becomes your last period of account. If you have decided to cease your trading, and if it is your last period of account, remember, in the last period of account, you cannot claim annual investment allowance, you cannot claim first year allowance, you cannot claim written down allowance. In the last period of account, you don't have annual investment allowance or first year allowance or written down allowance. What you have is either a balancing allowance or balancing charge. No AIA, no FIA, no WDA in your last period of account. The only adjustment will be the balancing adjustment, which will result in either balancing allowance or balancing charge. Okay, right. Then we are coming to an important area that you must be familiar with it, because at the exam, trading loss relief is actually a very important aspect. There can be questions from trading loss relief all the time. If you take any loss relief when you're studying, when you're studying, if you come across a situation where they discuss about a loss relief, always spend enough and more time to understand this. Because when you are advising a person in a given question, you should have the ability to explain what kind of reliefs available on a given loss. So loss relief is an important area under any topic. It can be capital losses, property losses, non-trading loan relationship deficits. It can be a trading loss, which is highly examinable. It can be any loss. You must be familiar with the reliefs available in such situations. So when it comes to an unincorporated business, one of the most important aspects that can be tested at the exam, reliefs pertaining to trading losses. But for you to understand the applicability of loss reliefs, there is a prerequisite, that is, you must familiarize yourself with the basis of assessment rules. Without knowing the basis of assessment rules, you will find it difficult to apply the trading loss reliefs available to a business. So within the time period that is available, I will try my level best to explain these things. Okay. Now, when it comes to basis of assessment, that's the concept that we have only applicable to unincorporated businesses. These basis of assessment rules are not applicable to corporates or companies, only applicable to unincorporated businesses. The main reason is when it comes to unincorporated businesses, the accounting period can be different from the tax year. If the accounting period is different from the tax year, there's an incompatibility between the tax year and the accounting period. To make them compatible, we are using certain rules. We call them basis of assessment rules. There are different types of rules applicable depending on whether it is a newly started business or ongoing business or a business which you are going to cease trading. And there are some special basis of assessment rules if you are going to change the accounting date. Since I have limited time, I will explain the important ones, that is, rules pertaining to opening years, ongoing years, and closing years. Now, when it comes to ongoing business, that means a business that you have already started. For those businesses, we are using something called current year basis. We use something called current year basis. Current year basis. For ongoing businesses, we are using something called current year basis. What is this current year basis? What is this current year basis? There you ask two questions. First question, is there a period of account ending in the tax year? Period of account ending in the tax year. If the answer is yes, is there a period of account ending in the tax year? If the answer is yes, then you ask the next question, how long is the period of account? Is there a period of account ending in the tax year? Say your tax year is 2019-20, starting on the 6th of April 2019, ending 5th of April 2020. 5th of April 2020. Your period of account ending on 31st December 2019. And if you are preparing accounts for the year ended, that means you are preparing accounts for 12 months period. 12 months period. So here, if the period of account is ending in the tax year 2019-20, here the answer is yes. And if the period of account is 12 months, how long is the period of account? Exactly 12 months. In that case, the whole tax adjusted trading profit that you have calculated for the end of 31st December 2019 must be taxed in the tax year 1920. That is what we call ongoing, current year basis applicable for ongoing businesses. However, if the business is a newly started business, then we have to apply some special rules. We have to apply some special rules. There, if it is a newly started business, first, you need to identify the first tax year of the business. Listen very carefully. If it is a newly started business, the first thing that you should do is identify the first tax year of the business. How do you identify the first tax year of the business? By looking at the date of commencement. So if you have started the business, say on the 1st of January 2018, 1st of January 2018, that is the commencement, the date of commencement, 1st January 2018. Then you need to identify your first tax year by looking at the date of commencement. 1st of January falls into the tax year 2017-18. 2017-18. 2017-18. 2017-18. So the first tax year is 2017-18. Then for the first tax year, you are using the basis called actual basis. Actual basis. For the first tax year, you must always use the actual basis. Actual basis. What do you mean by the actual basis? You need to identify the profits from the date of commencement to the last date of the tax year. In the first tax year, you have to pay taxes only on the profits from date of commencement to the last date of the tax year. We call it actual basis. But when it comes to the second tax year, the rules are a little different and complicated. So second, third years, you need to apply these rules, and you need to understand them very carefully. That's the most important part that you need to understand. In the second year, you have to ask the same question that I mentioned under current year basis. What is the question? Is there an accounting period ending in the tax year? If the answer is yes, then you ask the second question, how long is the period of account? Is it 12 months long or not? That means, is it exactly 12 months or less than 12 months or more than 12 months? First, you ask the question, is there an accounting period ending in the tax year? If the answer is yes, you ask the second question, is it 12 months long or not? Again, if the answer is yes, then the whole profit for that 12 months period must be taxed in the second year. But if the answer is no, if the accounting period is either less than 12 months or more than 12 months, then you ask the next question, is it less than 12 months or more than 12 months? So first you ask the question, is there a period of accounting ending in the tax year? Ending in the tax year? If the answer is yes, then you ask, is it 12 months long? Again, if the answer is no, then you check, is it less than 12 months or more than 12 months? If it is less than 12 months, you just need to memorize these rules. Memorize it and apply as it is without trying to analyze too much. So if it is less than 12 months, always remember, first 12 months of trade profit should be taxed in the second year. You need to calculate first 12 months trading profit, and that must be taxed in the second tax year. If the accounting period is more than 12 months, say you have prepared accounts for 15 months. In that case, out of 15 months, take last 12 months profit out of 15 months, exclude the first 3 months profit, just take last 12 months profit of the 15-month period and pay taxes on that in the second tax year. If there is no period of account ending in the tax year, no accounting period ending in the tax year, then you must use the actual basis. That is, just figure out the profits from 6th of April to 5th of April and pay taxes on that. Now you need to practice some questions from this area to get an understanding, but my advice is first memorize the rules and then try to understand how to apply them. And there, don't try to analyze it too much, just stick to the rules that you have been given and strictly adhere to the rules given here. Then, another area that you must be familiar with, closing year rules. That is your last tax year. What is the profit that must be taxed in the last tax year? What is the profit that must be taxed in the last tax year? That must be taxed in the last tax year. First, you need to find out what is my last tax year. Identify your last tax year. How do you identify your last tax year? For that, you need to look at the date of cessation. Just look at the date of cessation. Date of cessation is the date where you have ceased trading. Assume you have ceased or wound up the business on 31st December 2019. 31st December 2019. Then, according to your date of cessation, your last tax year is 2019-20. Your last tax year is 2019-20. So your one before last, you call it the penultimate year, one before last is 2018-19. For the penultimate year, you must always use the current year basis. For the penultimate year, you must use the current year basis. When you do that, you automatically realize there are certain profits that have not been taxed up until the penultimate year or one before last. For the penultimate year, you need to apply the current year basis. When you do that, you automatically figure out there are certain profits that have not been taxed up to the penultimate year. Whatever the profits that have not been taxed up to the penultimate year must be taxed in the last tax year. When you are doing that, don't forget to deduct any overlap profit that have arisen due to opening year rules. Sometimes when you are using the opening year rules, the same profit can be taxed in more than one tax year. When you are applying the opening year rules, it is possible that the same profit will be taxed in more than 1 year. We call them overlap profits. So actually you are paying taxes on the same profit in 2 different tax years. In such situation, at the time of cessation under closing year rules, when calculating the profits accessible in the last tax year, if you have any overlap profits, you can deduct them. And finally, within the remaining time that I'm having, let me quickly explain the loss reliefs available, because it is an extremely important area for the exam. Okay. Now, when it comes to an unincorporated business, you have to have the ability to compare the loss reliefs available to a company and to an individual. Now, here you are running an unincorporated business, probably as a sole trader. In that case, what are the loss reliefs available? The main relief is carry forward loss relief. Carry forward loss relief. How does it work? Unlike in a company, carry forward relief works for an unincorporated business in a different way. That is, you can carry forward the trading loss and set off against the first available future trading profits from the same trade. There are no optional claims, no partial claims are permitted. For an unincorporated business, when you carry forward a loss, it must be set off against the first available trading profit. First available trading profit. The maximum possible amount you must set off. Partial claims are not permitted, and you can set off only against trading profits. But in addition to that, as an ongoing business, there's another special relief available. That is, if you want, you can set off your trading loss against the current year and or the previous year total income, against total income. Without carrying forward, if you want, you can set off your trading loss against total income of the current year and or the previous year. So when you're doing that, you can decide whether you want to set it off against the current year or the previous year. If you want, first you can set it off against the current year and then set off against the previous year's total income. Or else you can first set it off against the previous year total income and then against the current year total income. Therefore, you have the liberty to decide whether you want to first set it off against the current year total income or the previous year total income, and you must set off the maximum possible amount. Any excess can be carried forward. Now, along with this relief, there is another relief extended. That is, you can set off your trading losses not only against your total income, but also against the chargeable gains of the current year and or the previous year. Current year and or the previous year. However, if you want to set off a trading loss against current year chargeable gains or previous year chargeable gain, there is a condition to be met. Assume you want to set off your trading losses against the previous year. You can carry back maximum 12 months, not more than 12 months. Under normal circumstances, you can carry back only 12 months. So if you want to use the chargeable gain of the previous year, there is a prerequisite. You cannot set off against the previous year chargeable gain at once. First, you need to set off the trading losses against the total income, first. If there is any unrelieved amount, only the balance can be set off against the previous year chargeable gain. So if you want to set off your trading losses against chargeable gains, you cannot do it at once. First, you should try to set it off against the total income of the previous year. Then only you can use the previous year chargeable gain. If you want to set off the trading losses against the current year chargeable gain, then first you must set it off against the current year total income. Only the unrelieved amount can be set off against the current year chargeable gains. When doing this computation, remember there's a maximum loss. There's a maximum that you can set off against your total income. What is the maximum that you can set off against your total income? So when you are using the current year and or the previous year relief against total income, other than trading income, there is a maximum you can set off against total income other than trading income. It is the higher of £50,000 or 25% of adjusted total income. Adjusted total income. It's not adjusted net income, it's adjusted total income. How do you calculate adjusted total income? From your total income, when you're calculating the taxable income, you get an answer called total income. From that, when you deduct gross personal pension contributions, we don't deduct gross gifted donations, you only deduct gross personal pension contributions. then you get an answer, we call it ATI. Take 25% of that amount and compare with 50%, take the greater, up to that amount you can set off against your total income, but other than trading profits. So that's the maximum deduction available. Then there are some other special reliefs available other than the reliefs that I mentioned. One other relief is opening year relief. Opening year relief. I will explain these three, and then we'll send the first session and give you a break. After that, we can do some questions from this area. Now, opening year loss relief, the only difference is if it is a newly started business, there is a special relief available. That is, if the newly started business has incurred a loss during the first 4 tax years, if the newly started business has incurred a loss during the first 4 tax years of the business, that loss can be carried back for a period of 3 years to set off against total income according to first in, first out basis. But this is a relief applicable only to newly started businesses. So if the business has incurred a loss during the first 4 years of the business, that loss can be carried back for a period of 3 years to set off against total income according to first in, first out basis. That is the opening year relief. Then, if it is a business where you have ceased trading, you're going to wind up the business. In that situation, you have a special relief called terminal loss relief. You have a special relief called terminal loss relief. How does it work? How does it work, the terminal loss relief? You first need to calculate the terminal loss. What do you mean by terminal loss? The loss incurred during the last 12 months of the business. You calculate the loss incurred during the last 12 months of the business, and that loss can be carried back for 3 years against trading profits according to last in, first out basis. You can carry back 3 years to set off against trading profits according to last in, first out basis. Last in, first out basis. Here you can set it off against only trading profits according to last in, first out basis. That means the latest one first. Here, the earliest one first. Then we have another special relief available. This is applicable if you have converted your unincorporated business into a company. If you have converted your unincorporated business into a company, remember, carry forward relief is not available. If you have ceased trading, if you have stopped doing business, is there any loss to carry forward to set off against future available trading profits? No, because you have stopped doing business. So you can't expect to have trading profits if you have stopped doing the business. Therefore, if you have ceased trading and if you have any unrelieved loss at the time of cessation, it will be completely wasted. But if you have converted your unincorporated business into a company, then any unrelieved losses, any unrelieved trading loss can be carried forward, but not to set off against the company's profit. But you can set it off against the income received by the shareholders from the company. Say, I is a sole trader, who is the owner of the business, sole trader. Now this business is converted into a company, and the owner now becomes a shareholder of this company. Company and the shareholder are two different persons for the purpose of taxation. So this sole trader business has a trading loss which you have not been able to relieve at the time of incorporation. Normally, that loss should be wasted. However, since you have converted your unincorporated business into a company and the same owner has become the shareholder of this company, loss can be carried forward to set off against the income received by this shareholder from the company. So in the future, when the shareholder is going to receive income from the company, maybe as salary, maybe as interest, maybe as dividend, against that salary, dividend or interest, this carry forward loss can be set off. That is what we call incorporation relief here. Okay, so you can see these are the main areas that can be tested. So let's stop at this point to get a small break. And after that, we will discuss some questions from the same area as usual. So I'll give you a break for a period of 15 minutes. So let's start after 15 minutes. Okay, let's start. So now we will discuss some questions from this area. I have picked a few questions. Let's see. I have selected question from March and June 2019 paper. Question number 14. Let's read it and see. Question number 14. Yeah, this is the one. So let's look at what we have to do here. The 20-mark question. Calculate Rod's after-tax proceeds from the sale of his shares in Lumba PLC and explain your calculation of the base cost for the shares. Actually, it's from capital gains tax. But I'm going to answer part B. Roman 1, calculate Rod's share of the tax-adjusted trading loss in the Thora partnership for tax year 1920 and 2021. The answer to this part B, Roman 1, should clearly show the relevant basis periods. Now, can you remember? I was referring to basis of assessment rules. So they want you to clearly show the relevant basis periods as well. Then state how Rodney is able to relieve the trading loss calculated in B Roman 1 above as early as possible. So you can see, first you calculate the trading loss, applying the basis of assessment rules, and then they are asking how you can relieve the trading loss that you have calculated. And the requirement is you need to claim the relief as early as possible and explain with supporting calculations the total amount of income tax saved if Rod follows this strategy. You should assume that tax rates and allowances for the tax year 1920 apply to all tax years. So let's read the relevant parts of the question. Rod has requested advice in relation to the capital gains tax implications of selling shares he obtained through his employer's Enterprise Management Incentive Scheme, EMI, and the potential income tax relief available in respect of his share of trading loss of a partnership which he has recently joined. It says recently joined. So now that aspect is important. When you're applying the basis of assessment rules, recently joined indicates for him, it's a newly started business. So if he has joined for the first time, though the partnership has been running, for Rod, it's a newly started business. He joined for the first time, so then it's a new business for him. Rod is resident and domiciled in the UK. was employed for many years by Lumba PLC before taking early retirement. That's not relevant to our question. Joined the Torah partnership. Now, this is important on the 1st of December 2019. For him, he started the business on the 1st of December 2019. Remember, a partnership is not a taxable person. A partnership does not have to pay taxes like a company. Now, you know, a company has to pay taxes on its own. It is subject to a separate tax regime called corporation tax. But a partnership is not subject to any tax. A partnership does not have to pay taxes, but the partners of the partnership should pay taxes independently and separately. So each partner's tax liability is on the profit share that they derive from the partnership. So you need to calculate the profit attributable to each partner or loss relevant to each partner, and you should consider it separately in isolation from the partnership and the other partners. So even though you're in a partnership, every partner should be treated individually as if they are in a sole trader business. Made no disposal for capital gains tax that's not relevant. Only 1st of December 2019 part is relevant for this question. From this part, sale of Lumba PLC shares not relevant to answer part B, but this is important. Torah partnership has been carried on for many years by two partners, Abe and Bob, but that's not relevant to us because Rod joined the business on the 1st of December 2019. Whether the partnership was in business for many years with two partners, it's not relevant because we are supposed to calculate the situation with regard to Rod, who has joined the partnership on the 1st December 2019. Prepare accounts to 30th November annually. Now that's important. Admitted Rod into the partnership 1st December 2019. That is also important. Is expected to make a tax-adjusted trading loss of 47,000 in the year ending 30th November 2020. The Torah partnership profits loss sharing arrangements. The partnership profit loss sharing arrangement from 1st December 2019 are as follows. Annual salary 20,000 to Bob and Abe. No salaries to Rod. Profit loss sharing, they share the losses equally. Now here you have been given the tax adjusted trading loss not for each partner but for the whole partnership. What we need to find out is what is the loss attributable to Rod, who has joined on the 1st of December 2019, and that depends on the partnership agreement, right? So Rod's income in the tax year 2016-17 to 19-20. Employment income 16-17, 17-18, 18-19, and 19-20. Okay. So this is not going to be a complicated question if you are familiar with the rules. Again, I will remind you that I'm going to use the Microsoft Excel. However, you will also be given a spreadsheet at the exam, and that spreadsheet will be a little different from Microsoft spreadsheet, as most of the features available here will not be available there on the platform that is provided to you at the exam. So what you can do is go to my ACCA and you can practice your questions on the platform that will be available to you at the exam. So you can rehearse certain questions. You can rehearse your questions using the platform available to you through my ACCA. So please use that platform when you're answering questions. So that will be a good practice session prior to the exam. Okay, as usual. Right. First, you need to calculate the distribution of trading loss. So here, total, and we have Abe, Bob, and Rod. He joined on the 1st of December 2019. So they have given the loss for the year ended 30th November 2020. The total loss is £47,000. The total loss is £47,000. Total loss is £47,000. From that, you pay a salary 20,000 to Abe and 20,000 to Bob. Okay. So don't forget that this is a loss that you're having. So here 0, you get 40,000. You get 40,000. And then we have a trading loss, 47,000. On top of that 47,000, you have to pay 40,000 as salaries. Therefore, the total loss is actually 87,000 here. The total loss is 87,000. Now this 87,000 loss, you have to share between the three partners according to the profit sharing ratio. So you have a 47,000 loss. On top of that, you have to pay salaries 40,000 to two partners. Then the loss is going to increase more. You already have a loss of 47,000. In addition to that, you have to pay salaries to the partner. So your loss is going to increase by another 40,000. So total loss is 87,000. And this you have to share equally among the partners. 87, 1:1:1:1. So divide by 3. So 29,000 is the loss here. 29,000. So this is your loss. Now, what matters is this 29,000 loss attributable to Rod in this situation. 29,000 loss. Okay. So his loss, Rod's loss for the end at 30th November 2020 is £29,000. Okay. So Rod is having a trading loss for the year ended 30th November 2020, which is £29,000. £29,000 loss. Okay. But the loss attributable to each tax year depends on the basis of assessment rules. Now he joined the partnership. One second, guys. So here the loss is for the end at 30th November 2020. The loss is for the end at 30th November 2020. He joined the partnership on the 1st December. He joined the partnership on the 1st December 2019. Now for Rod, it is a new business. You have to look at from Rod's point of view. The question says the partnership was in business for so many years and there were two other partners. That is not applicable to Rod. As an individual person, Rod has joined a business and for him, it's a newly started business. Therefore, you need to find out the loss attributable to each tax year for Rod. He joined the business on the 1st of December 2019. For him, it's a new business. Therefore, you need to apply the opening year rules here. You need to apply the opening year rules. Accordingly, the first thing that you need to do is identify the first tax year. Identify the first tax year. How do you identify the first tax year? How do you identify the first tax year? By looking at the date of commencement. He started his business as a partner in the partnership on the 1st December 2019. So the date of commencement is 1st of December 2019, which falls into 2019-20 tax year. Which falls into 2019-20 tax year. For the first tax year, you need to use the actual basis. You need to use the actual basis. What do you mean by actual basis? You need to find out the profit or loss from the date of commencement, which is 1st of December 2019 to the last date of the tax year, 5th of April 2020. So you need to find out the profit or loss from 1st December 2019 to 5th of April 2020 during the first tax year. Now, we have calculated the total loss, which is £29,000. That is for a period of 12 months. But on the actual basis, here we need to cover how many months? December, January, February, and March. 5th of April, extra 5 days, you can just ignore it. So here, during the tax year 1920, we have to find out the profit or loss only for a period of 4 months. So 29,000 is for a period of 12 months. And now you divide by 12, multiplied by 4 to find out the loss for 4 months. Accordingly, you get 9,667. 9,667. So that is the loss for that period. That is the loss for that period. Okay, right. Then the next tax year, second tax year. Second tax year. That is 2020-21. 2020-21. 21. Second year, what is the basis that we are using? For that only, we had to apply those special rules. Can you remember these rules? Second tax year, you ask the question, is there a period of account ending in the tax year? Is there a period of account ending in the tax year? So, your period of account ending 30th November 2020. Second tax year, starting on the 6th of April 2020, ending 5th April 2021, right? 2021. Now your accounting period ends on 30th November 2020. Year ended 30th November 2020. So your period of account ending date falls into 2021 tax year. So the answer to this question, whether there is a period of account ending in the tax year, the answer is yes. Then you ask the second question, how long is the period of account? Is it 12 months long? Yes, you have prepared accounts annually for 12 months. So yes, there is a period of account ending in the tax year, and also the period of account is 12 months. In that case, you must use the current year basis, and the whole profit must be taxed here. The whole profit must be taxed here. If you have a profit, the whole profit must be taxed here, and that may result in an overlap profit. Now assume this 29,000 is not a loss. Assume this is a profit, then the full profit 29,000 should be taxed here. But if you do that, as I mentioned, this will result in an overlap profit, because for the previous tax year, from this 29,000 pounds, we took 4 months profit. Assume for a moment this is not a loss, this is a profit. So in that situation, in the first tax year, from this 29,000, we took 4 months profit. And then again, in the next tax year, we have to take the full amount, 29,000. So if you take 29,000 here, in that this 9,667 already included. Therefore, this will result in an overlap profit of 9,667. That means on the same profit of 9,667, you are paying taxes twice. But that is understandable, and there is nothing that you can do about it. It is unavoidable. There will be an overlap profit. But here the important thing that you need to remember is that there's nothing called overlap losses. There can be overlap profits, but there's nothing called overlap losses. So you cannot have the same loss in the next period as well. Here you have a loss of 29,000. Here you have a loss of 29,000. You have a loss of 29,000 pounds. You have a loss of 29,000 pounds. But from that, for the previous period, you have already taken a loss of 9,667. You have loss of 29,000 according to current year basis, but for the previous period, from that 29,000, you have already taken 9,667. You need to exclude that amount when calculating the loss relevant for the second tax year. The reason is there is no concept called overlap losses. You can have overlap profits, but you cannot have overlap losses. That's the reason. So here is Arun. Let's see. The answer is 29,000 minus 9,667. So you get a loss of 19,333. In total, it's 29,000. In total, it's 29,000, out of which for the first tax year, you have a loss of 9,667. And for 2021, you have a loss of 19,337. 33. 19,333. Okay. Now let's look at the question. So we have identified the losses. Then the question says, actually this is part A, part B, Roman 1. This is the answer for B, Roman 1. B, Roman 1. So this is the answer B, Roman 1. So just a matter of applying the basis of assessment rules. Share of tax adjusted trading loss is share of tax adjusted trading loss. Always when you're answering a question, make sure that you have addressed all the issues. Because sometimes in a given question, you will have to answer more than one particular issue. So at the end of the day, check whether you have addressed all the issues raised in the question. Here, calculate Rod's share of the tax adjusted trading loss in the Torah partnership. Yes, we have calculated the loss attributable to Rod in this Torah partnership is 29,000 pounds. But here they want us to find out the tax adjusted trading loss in the Torah partnership for the tax years 2019 and 2020-21. So they want us to calculate it separately for each tax year 19, 20 and 21. Your answer to this part should clearly show the relevant basis period. So you have shown it clearly. The actual basis, the current year basis, and we have accordingly calculated the relevant trading losses for the current year, for the first tax year and for the second tax year. Now we can answer B, Roman 2. So for that, they have allocated 6 marks, quite substantial. And this is, as I said, from 19 September, June papers. Then state how Rod is able to relieve the trading losses calculated in B, Roman 1 above as early as possible. That's the requirement that we need to satisfy and explain with supporting calculations the total amount of income tax saved if Rod follows this strategy. Okay, here you have to get the relief as early as possible. Now for Rod, this is a newly started business as he joined the business for the first time on the 1st of December 2019. It's a new business for him. If that is the case, these are the reliefs available. You always have the carry forward relief. You can carry forward your trading losses to set off against the future available trading profits. Or else you can set off your trading losses against the total income of the current year. Against the total income of the current year and or the previous year. Or else you can set it off against the chargeable gains of the current year and or the previous year. And the other option available is the special opening year relief, as it is a newly started business for Rod. According to opening year relief, if you have incurred a loss during the first 4 tax years of the business. Rod started the business on the 1st December 2019, and during the first 4 tax years of the business, if he has incurred a loss, so in the first tax year, he has incurred a loss of 9,667. Second tax year of his business, he has incurred a loss of 19,333. So it appears that Rod has incurred a loss during the first 4 tax years of the business that can be carried back for a period of 3 years. That can be carried back for a period of 3 years to set off against total income according to first in, first out basis. According to first in, first out basis. The question wants you to claim the relief as early as possible. In that case, the best relief available out of the reliefs that I mentioned, they are carry forward relief, relief against total income and or the previous year, relief against chargeable gains of the current year and or the previous year, and the special opening year relief where you can carry back not just 12 months but 3 years to set off against total income. So out of the reliefs that I mentioned, the most suitable relief is opening year relief. The most beneficial, no, we shouldn't say that most beneficial. The requirement is the relief that you can claim as early as possible. Use opening year relief to claim relief as early as possible. As early as possible. So for that, what we should do is we need to, his first tax year is 2019-20. His first tax year is 2019-20. Then we have 2020-21. 16-17, 17-18, 18-19. 2016-17, 17-18, 18-19. So in this situation, we have employment income, employment income, 16-17, 82,000 pounds, 17-18, 90,000 pounds, 18-19, 86,000 pounds. And 19-20 also we have 26,000 pounds. Then dividend, nothing, 16,000, 12,000, 8,000. Right. Then we can get the total income. So opening a relief, you can claim it against total income, 82,000. Here, 106,000. Here, 98,000. Here, 34,000. Here, 34,000. Okay. Now, against this total income, you can claim the loss relief. Opening year loss relief. First, we will take 2019-20 loss. 2019-20 loss. 2019-20, you have a loss of 9,667. That loss you can carry back for a period of 3 years to set off against the total income according to first in, first out basis. So when you apply the first in, first out basis, you have to start with the earliest year first, that means 16-17. So for 19-20, you have a loss of 9,667, which you have incurred within the first 4 tax years of the business. So you can claim the special opening year relief, where you can carry back the loss for a period of 3 years. And to set off against total income according to first in, first out basis. When you say first in, first out basis, you have to start with 16-7 first, then 17-18, finally 18-19. However, your loss is only 9,667. Therefore, the full amount, you can set it off against 16-17 total income. Loss relief. For 2019-20. And then loss relief for 2020-21. 2020-21. So there you have a loss of 19,333. So 2021, you have a loss of 19,333, and you can carry back this loss for through 3 years. 1, 2, 3. So you can't reach 16-17. Maximum you can carry back 3 years. So from 2021, you carry back 3 years, 19-20, 18-19, 17-18, according to first in, first out basis. So you have to start with 17-18, which is 19,333. So when you deduct, you get an answer that is what we call net income. You don't have to actually show the net income. They just want you to explain the tax saving that you can have. The tax saving that you can have. So here the net income will be this. Okay. So state how Rodney is able to relieve the trading losses as early as possible. So in this particular way, 9,667 and here 19,333. So you can claim the full loss there. And explain with supporting calculations the total amount of income tax saved if ROT follows this strategy. So here, the tax saving, you can calculate like this. If you did not have this 9,667, even though you have this or not, you have been taxed as a higher rate taxpayer. You anyway have a total income of 82,000. So even though you deduct the personal allowance, you will be a higher rate taxpayer. Therefore, as a result of this loss relief of 9,667, you can save taxes at the rate of 40%. You can have a tax saving as a higher rate taxpayer at the rate of 40%. So there you get a tax saving of 3,867. 3,867 for 16-17. In this year also, you would have been a higher rate taxpayer. However, you have to be little careful when you're doing this computation. You have to be little careful when you're doing this computation. That is, try to understand. Less. Normally what we do after net income, you deduct the personal allowance. So then you can deduct 12,500. Here also 12,500. I'm not going to compute for the others, but only for these 2 years relevant, because you don't have to waste your time. Taxable income. Now, what is the tax saving for 17-18 tax year? 16-17, you have a tax saving of 3,867. But what is the tax saving? What is the tax saving for 17-18? Okay. Yeah, we have no problem actually. No, we have a problem here. We have a problem. Now assume this relief was not there. Assume, I'm taking it separately, listen carefully, because there are shortcuts. Now I have to take time to explain it, but if you understand the computation, it doesn't take even few seconds to get the answer. Assume this loss relief is not there. This loss relief is not there. Then what would have been your net income? What would have been your net income? Net income, assuming the loss relief is not there and you have not claimed the loss relief, your net income would have been 106,000. Then how much should have been the personal allowance? Do you think you can claim the full personal allowance 12,500? Yes, that's right. If you had a net income of 106,000, do you think that you would have been able to claim the full personal allowance? No. Reason is your personal allowance will be reduced. Your personal allowance will be reduced if the adjusted net income is greater than £100,000. If the adjusted net income is greater than £100,000, your personal allowance would have been reduced. How? By how much? Personal allowance is 12,500. It should be reduced by adjusted net income. In this situation, how do you calculate the adjusted net income? Net income minus gross personal pension contributions and gross gift aid donations. In this question, we do not have gross personal pension contributions, gross gift aid donations. Therefore, my adjusted net income is equivalent to net income £106,000. £106,000. So adjusted net income is £106,000 minus £100,000, which is fixed, and that multiplied by 50%. That multiplied by 50%. From that amount, my personal allowance should be reduced. That means how much? Here difference is 6,000 into 50%, £3,000. So if I did not claim the loss relief, then my personal allowance would have been not 12,500, but 9,500. As a result of the loss relief claim, now I am in a position to claim the full personal allowance. Because of the loss relief, my net income became 86,667. Therefore, my adjusted net income is equal or less than £100,000. As a result of that, I was able to secure full personal allowance of 12,500. Without this loss relief of 19,333, my adjusted net income would have been 106,000, and as a result of that, the personal allowance would have been reduced by £3,000. Now, because of the loss relief claim, I have received two benefits. One is my taxable income came down by 19,333. At the same time, I was able to secure the full personal allowance, otherwise would have been reduced by £3,000. So one relief on this 19,333, I was able to I am now in a position to get a tax saving at the rate of 40% as a higher rate taxpayer. And the other thing is I got another benefit that my personal allowance now increased by £3,000. Again, I get a tax saving at the rate of 40%. I get a tax saving at the rate of 40%. So accordingly, here on this 19,333, I receive a tax saving at the rate of 40%. That's one. In addition to that, I receive another benefit. That is on this 3,000, where I was able to now increase my personal allowance by £3,000, where I can save taxes at the rate of 40%. Here, 1,200. So in this situation, 16-17, 3,867, 2017-18, there is a tax saving of 8,933. The total tax saving is 12,800. So because of the opening year loss relief, he is in a position to save taxes in total 12,800. I hope that you can understand this computation. It is extremely important that you are in a position to get these figures with supporting calculations without spending much time. Now, I had to take time because I had to explain it. Otherwise, if you understand the application of tax computation, if you know the way to calculate the tax liability, this answer you would have been able to obtain without any problem, without wasting much time. So that's about that question. And now let me try to answer another question. So say the previous question. Yeah, now in this situation, because of the loss, we were able to save the personal allowance. But at times there can be questions at the exam where you lose your personal allowance also due to losses. So there can be situations like that, but mostly you are in a position to secure the personal allowance due to loss relief. Anyway, let's see what kind of a question is this. Yeah, so you can see this is also a past paper question. We try to answer as much as we can from this question. Now, at the exam, when you're writing an answer, remember, do not waste your time to write lengthy explanations. The examiner doesn't expect you to write lengthy explanations. You can explain your answer in few sentences. However, the key points must be included in your answer. Now, for an example, here, it is extremely important for you to mention the type of relief that you have claimed, whether it's a relief against total income of the current year and or the previous year, or whether it's a carry forward relief. So you have to use your key words in your answer. In such situations, you will be able to get good marks without any problem. Even though you have taken a lengthy explanation, if you have not addressed the main principles, you are not going to get marks at the exam. Okay, so that's how it works. So always make sure that key points are highlighted, key points are expressed clearly without wasting much time by writing lengthy explanations. Calculations also. Now, even though I calculated the taxable income, personal allowance here, it's not essential. Calculating the net income would have been more than enough. However, this computation is important, so because the tax saving will be based on that. Okay, and you can always use abbreviations, PA, IHT, it doesn't matter. You are not given marks for formatting. Don't waste your time to format your answers, because for formatting, marks are not allocated. So whatever the format that you maintain, you don't have to justify these figures, even though I do this, I center it. Don't waste your time to do that. Just leave it as it is. If the calculation is right, and if you have explained it with the relevant keywords, then you will be given marks. So let me quickly look at this question also. What do you have to do here? Calculate taxable trading profit of MT Travel for each of the tax years 19, 20, and 21 before considering relief for the anticipating trading loss of the tax year 21, 22. So you can see a lot of questions are pertaining to trading losses. Identify and explain one practical tax advantage of MT Travel having 31st March year end rather than a 31st December year end. Now this is from basis of assessment rules. Calculate the allowable trading loss available to each of Meg Laurie for the tax years 21-22 if Laurie becomes an employee or alternatively a partner in MT Travel. Advise Meg and Laurie of the alternative ways in which their respective trading losses as calculated in B Roman 1 could be used depending on whether Laurie is taken on as an employee or as a partner, and state the rate at which income tax would be saved in each case. So here, altogether allocated 16 marks, but the last part is from value-added tax, 4 marks allocated. So you can see, this is also a past paper question. So 16 marks, 16 substantial marks allocated for this question. So that's why I took my time to address these principles during this session. Meg is an unincorporated sole trader. She requires advice regarding a planned change of accounting date, bringing her husband into the business either as an employee or as a partner, and the value-added tax. Meg is 60 years old and is married to Laurie, owns an unincorporated sole trader business, MT Travel, has a rental income of 8,600 each year in addition to any profits from MT Travel. MT Travel was set up by Meg on 1st of January 2015. It had accounts prepared to 31st December annually, 31st December. annually, generated overlap profits of 7,400 on commencement. MEC will change its accounting date to 31st March by preparing accounts for the 15-month ending 31st March 2021. Currently has no employees. Empty travel, reason and forecast tax-adjusted trading profits. So they started the business sometime back on the 1st of January 2015, preparing accounts 31st December annually. Now you have decided to change the accounting date. So if there's a change in accounting date, then this will also result in either more overlap profits or relief of some of the overlap profits that you had already. Okay. Now, here you can see change of accounting date. If you are going to change the accounting date, it must be notified to HMRC on or before 31st January following the tax year. The first accounts to the new accounting date should not exceed 18 months. And there should not be another change of accounting date during the previous 5 tax years unless for a genuine commercial reason. Okay, so when you're doing change of accounting date, the outcome date depends on the new date is an earlier in the tax year. The new date is earlier in the tax year. The basis period for the tax year of change 12 months to the new accounting date. This creates extra overlap profit. New date is a later date in the tax year. Overlap profits will be used to reduce the assessment to 12 months. Now, what do you mean by this? According to the question, the earlier accounting date was 31st December. You used to prepare accounts to 31st December. The new date is 31st March. So hereafter, you are not going to prepare accounts to 31st December. You are going to prepare accounts to 31st March. Tell me, out of these two dates, which one is the earlier date in the tax year? Which one is the earlier date in the tax year? Or tell me whether the new date is an earlier date or later date compared to 31st December. So you're saying, Arun is saying, December is the earlier date. Matusha is saying 31st March is the later date. Okay, right. Now, how do you identify? Unlike a calendar year starts when? January. But the tax year starts when? April. Tax year starts in April, 6th of April. So if you look at the tax calendar, the first month of the tax calendar is April. Second month is May, June, July, August. And the last month of the tax calendar is March. So 31st December was actually an earlier date. 31st December was an earlier date, and the new accounting date is a later date in the tax year. So the new date that you have picked is a later date in the tax year. Then there you will be able to use some of the overlap profits to bring down your taxable period to 12 months. So let's now look at the answer. Let's look at the answer now. So you will not be able to understand if you have not gone through it. Don't get disheartened. If you can't have a clear understanding, it's simply because you have not gone through it properly. So within the balanced time period, you have enough and ample time to go through it and to improve your knowledge. Okay, so don't worry about that. You have enough and more time to get ready for the paper. Okay, so now what we should do is year ended 31st December 2019. Year ended 31st December 2019. For that, we are applying the current year basis, 1920. We are applying the current year basis accordingly. Year ended 31st December 2019. That 17,000 should be taxed. 17,000 should be taxed. And then we have 2021. 2021. Now, in this instance, remember, we have an accounting period. So it's like this. I'll explain it. The previous period you started. Okay, no, I'll do it this way. 15 month ending 2021. That means 1st of January 2020 to 31st March 2021. So for this period, it's 15 months. 15 months. However, the assessable time period cannot exceed 12 months unless the first tax year or last tax year. The first tax year can be less than 12 months. Last tax year can be more than 12 months. However, except for the first tax year and the last tax year, according to basis of assessment rules, should always be 12 months. However, here we have 15 month ended 31st March 2021. There is a profit of £9,000. However, an assessable period cannot exceed 12 months. Therefore, you should bring down this 15 months to 12 months. You should bring down this 15 months to 12 months. How can you do that? This business is having an overlap profit of 7,400 on commencement. 7,400 on commencement. Now, you need to find out. Now, there's another thing that you have to do. When you started the business on the 1st of January 2015, listen carefully. On 1st of January 2015, I will be able to explain only the first part, only this part, because of the time constraint. But it's always, I advise you to go through this question. It's a good question. And if you have any difficulties, you can always talk to me on my WhatsApp number for any clarification. So let me finish this. 1st January 2015, you commence the business. That means your first tax year is when? How do you identify your first tax year if you started the business on 1st of January 2015? Your first tax year is 2014-15. Your first tax year is 2014-15. 2014-15. What is the basis that you have to use for the first tax year? So your first tax year based on the date of commencement 2014-15. And for the first tax year, you should always use the actual basis. Actual basis. Actual basis means you need to take the profit from the date of commencement, that is 1st of January 2015, to the last date of the tax year, that is 5th of April 2015. 2015. That means 3 months profit. 3 months profit. And the second tax year 2015-16, you would have used the current year basis because you have prepared accounts annually to 31st December. That means under current year basis, year ended 31st December 2015 would have been taxed. Now this would have resulted in an overlap profit for 3 months. So this 3 months profit will be included in the year ended 31st December 2015 computation. This 3 months profit should have been is included in this 31st December 2015. Therefore, this results in an overlap profit. Overlap profit. So 3 months profit, overlap profit. How much is that? Overlap profit of 7,400. So overlap profit 7,400 is for a period of 3 months. Now coming back to the question, we have prepared accounts to the new accounting date, which is a later date in the tax year compared to what we had previously. And assessable period cannot exceed 12 months, though we have prepared accounts of 15 months. So 15 months time period should be reduced to 12 months. How can you do that? If you have any overlap profit, that overlap profit can be used to reduce the 15-month period to 12 months. So overlap profit here exactly for 3 months. Therefore, what you can do is use 3 months overlap profit, 3 months overlap profit, and bring the assessable period to 12 months. So here, 7,400, you can get a relief, and the amount taxable for this period would be only 1,600. So after changing the accounting date, 2021 assessable profit will be 1,600. You picked a later date in the tax year as your new accounting date, where you have prepared accounts of 15 months. However, the assessable period should be reduced 12 months according to the rule. For that, you can use the overlap profits. If your overlap profits say it's for 6 months, then 7,400 divided by 6 multiplied by 3, because you have to bring it to 12 months. But here we have exactly 3 months overlap profit. So from 15 months, when you deduct 3 months overlap profit, it becomes 12 months, and the assessable profit would be 1,600. So what you should do is, as I mentioned during my presentation, it is extremely important for you guys to familiarize yourself with basis of assessment rules under opening year rules, closing year rules, ongoing business, and changing the accounting date. And the other important thing is availability of trading loss reliefs. There are 5 reliefs: opening year relief, terminal loss relief, carry forward relief, relief against total income of the current year and or the previous year, relief against chargeable gains of the current year and or the previous year. So for you to deal with a trading loss relief question, the prerequisite is you should know how to apply the basis of assessment rules. You should have the ability to deal with basis of assessment rules. Basis of assessment rules. So because of that, remember, when you're studying unincorporated businesses, make sure that you know the basis of assessment rules and trading loss release available. So let's stop at this point, and tomorrow will be the final date of this session, where I will try to discuss some important aspects with regard to corporation tax, which is one of the most important areas in your syllabus, where you need to have a very thorough understanding when you prepare yourself for the exam that you are going to have in September. So let's stop at this point and see you tomorrow at the same time. Until then, take care. Good night.